Start right. Yep. All right. Hey, good afternoon, good morning, everyone, or good evening, depending on where you are in the world. Glad to be kicking off this third deep dive underwriting session that we're doing in our series here. We'll officially kicked off about 1 minute. I know we got people rolling in here, so I just want to make sure that everyone gets a chance to roll in. So I see a lot of people rolling. Can someone just let me know in the participant section that you can hear me, see my screen, just in the chat box or Q&A. Let me know. Oh, all right. See some raised hands. See some comments coming in here. And if you can, also let me know where you're from. We often have a national audience and sometimes a few people overseas as well. Okay, but to kick things off here, this is our, like I said, our third session in our deep dive underwriting series. Now, today's session is going to focus on analyzing a debt fund and understanding how the borrowers, how the loans, how they're underwritten, and ultimately how they translate back to your return as an LP investor. Now, RD Advisors is coming on the show today to actually review their RD Real Estate Debt Fund 2. So we'll kick off with a short executive summary on just what their debt fund is, and we'll go into the deep dive of under the hood on how they underwrite everything as well. So my name is Chris Lopez. I am the Passive Pockets host today, where I get the privilege and to talk with these guys and ask a bunch of questions. So I'm a big fan of debt funds. I love reviewing them, and I love seeing the mechanics of it. But quick disclaimer here, Passive Pockets is not endorsing any deals, not making recommendations. Our goal here is to help you understand how funds, how deals make money, so you can go out there and do a better job of due diligence and then invest in the appropriate funds for you and your family. But it's time to jump into it. And we got three people from RD Advisors on here. I'll welcome back Sean Kelly Rand, who is on our LP deal review.
Hey guys. Hey everyone.
We got Michael Peterson. Good afternoon, Michael.
Good afternoon.
And then we have Juan Carlos as well. So we're going to switch some screens here so they can pull up their presentation and start going through materials. So Michael, I'll let you take over the screen. And I think, Juan, you're going to kind of lead us through the summary here and give us some background on everything.
Yes, I will. And thank you for having us, Chris. We're very excited.
Thank you, everyone. We see your screen. Great.
There we go. Perfect. All right. So just wanted to welcome everyone. Thank you guys for joining us today on this deep dive presentation. I think we're going to go a little bit further than we typically go when we're presenting the fund. So we're very excited to walk you through it, basically walk you through what we see every day as people who are actively running this strategy. I think, the Q&A function is enabled in this webinar. So if you have any questions throughout the presentation, please feel free to ask them. And we have 3 members of the team here ready to answer them. So just to walk you through it, RD Real Estate Debt Fund 2 is the fund run by RD Advisors, which is a private lending company headquartered in Boston with offices in New York and Lima, Peru as well. The fund was set up in 2017, so the strategy has been running for the last 8 years, of which, and I've been a part of it since 2020, so almost 6 years at this point that I've been working with Sean, and it's been a great ride, and it's been fantastic to see the strategy grow over the last couple of years. What do we focus on, and what does the fund do? So over the past years, the focus of the fund has not generally changed. We've been focusing on shorter term senior real estate debt. This is a capital preservation, kind of consistency focused strategy. The focus is on senior debt only. And where is that senior debt? In primarily residential properties in the greater Boston area. And that includes the city of Boston, the suburbs that surround it, and parts of the surrounding states as well. So it includes parts of Rhode Island, New Hampshire, and a little bit of southern Vermont. RD Advisors was set up by Sean Kelly Rand, who's joining us here today. Sean has held prior roles in real estate private equity, real estate private credit. He's developed his own projects in the greater Boston area. He's a Boston local, Boston native, so he knows Boston better than I think anyone else on this call. And it was a partnership between him and Dominion Capital, which is a single family office based in New York. Sean, is there anything you'd like to add about?
I think let's kind of kick it off with kind of like what we're going to go over in the webinar. I think Juan, who's been with us for a while now, you'll speak with him, and he'll be your point of contact along with Michael Peterson from the investor relations side, and in terms of investing in the fund. But they've also, Juan Carlos has also worked on the investing side, so he transitioned from the investing side to the investor relations side. And why that's important for us is when you're speaking with him, he's somebody that you can ask questions about, how we close loans, because he's closed quite a few of them. So he's going to help us out on some of these things here too. But one of the things we're talking about, and this is different than an individual deal. So I think a lot of these things, when you go into Bigger Pockets or any other places, we talk about an individual transaction. What we're talking about here is very different, right? In some sense, it's a strategy, right? So we're recycling capital over and over again, right? So there's no, typically a loan will be on our books for about 14 months. And so if you have 100 loans on our books, it means that every single week, the loan portfolio is changing slightly, right? So loans are coming off and loans are coming on. So what's more important than each individual loan, because we've done over, kind of 380 million, probably over 400 million by now. I think that was the end of last quarter. That's over 400 loans. So what's more important is how we do them, because that's what's going to be determining in the future. So it's kind of, I wouldn't say there's a predictor of future success, but what is our process, right? How do we evaluate and how do we do these, and why are we able to generate these consistent returns? And so that's what I'll be going through today. And then my background, as he stated, is real estate, private equity, and in banking and debt. And then I've done my own real estate development projects, very similar to kind of what, a lot of the Bigger Pocket stuff is. And I've spoken to Scott Trench in the past, and a lot of Bigger Pockets guys. I own a portfolio of real estate. That's how I got into it. In 2017, I stopped buying and switched over to the debt side. And so I've continued doing small bits of recycling of my real estate portfolio, but the vast majority of my new investment all goes into this fund. And the same thing with the family office. They kind of switched over at that time, 2017, and went into real estate debt. And hopefully you'll see why we did it as we go through the presentation. So Juan Carlos, you want to go through this? Slide here.
Of course. So as I mentioned before, this is a strategy that aims for consistency. That's what we strive to deliver every quarter. So this past Q2, we delivered our 33rd consecutive quarter of positive returns. So that's every single quarter since the inception of the fund in 2017, and our 31st consecutive quarter of LP distributions. So every quarter, we distribute a portion of our returns as income to those partners that seek to that want to receive distributions. The discrepancy between both of these numbers was just because in the first two quarters since fund inception, we didn't make any distributions while we were deploying the capital initially. But every quarter since then, we have been distributing income to our LPs. You can see the returns over here over time. So, by now, over 8 years of running the strategy, an LP who would have invested since inception would have over doubled their money. Our, trailing 12-month returns for both Class A and Class B have been over 10%. The discrepancy between classes here, just so you understand, is Class B are the original investors who came in at the first stage of the fund, so since inception. When the fund was set up, it was a closed-ended fund with a fixed end date. Over time, as we were growing the strategy, we realized that there was a lot more room for growth. So we switched to an evergreen structure. So now, and that's the Class A investor. So now every investor that comes in is coming into an evergreen structure. There's no end date to the fund as of this moment, and we have monthly closings.
And there's
Sean,
also
is there anything else you'd add?
Yeah, so Class A, to give you an idea. So Class B was the original investors. They were locked in for essentially 7 years. New investors coming on, it's a 1-year lockup. So it's an evergreen structure. There's no end date to the structure, but investors can redeem, start the redemption period after a year, right? They need to give us a quarter update, but we can go through that some at the end. But again, one of the things to talk about here is the reason we do this, right, is the consistency of returns, right? So I think if you look at this in my own individual portfolio of real estate, even my rental income is back and forth all the time, right? So you have great rental income, and then all of a sudden, my friend who owns a huge rental portfolio says, I do really well except for the months that I have to replace a roof. Given I have 100 properties, I'm replacing a roof every single month. And I think that's the difference here on the debt side is it's a fixed income product. So we have senior loans here where regardless of what's happening on the equity level, they owe us the interest payments, right? And if they don't, then they're in default. And we'll go over what that means and how we handle that later. But it's that consistency, which is why I'm an investor in this, what drove us to do this in the first place. So, but we'll flip through here. And then now we're going to talk about how do we get this consistent returns, right? But Michael, can you, next slide. So we'll go through, this is interesting. We want to jump into what does our loan tape look like? So this is our loan tape. There's a lot of details here. If you want to just zoom in, Michael, just kind of see if we can get a little bit closer so people can actually, 100%. So I want to, like, this is like, as of last quarter, what did it look like? How many loans are in the book? We're not going to go through all of this, but this gives you a general idea of how we track it. This is an export of our loan system prettied up in, Google Docs. And I think, so, that's just kind of like an overview of how many individual positions are in there. Now, if we flip to, can you flip back to the slides? What we try to do is summarize this data in a nice way for you so that you can see it in a lot easier than reviewing a loan tape. So our current portfolio, this is as of last quarter, is about 77 loans. In general, we're probably anywhere between 60 and 100 loans in the portfolio at any one time. That's close to 120 million of principal loan amount. That includes some of the draws that are undrawn from development loans. Initial term, typically they're 12-month loans. I think there's a few loans out there that we've done in the past that have maybe been 18 months, but the vast majority are 12-month loans. How long historically has it taken these loans to pay off? 14 months. What's the difference? There's a 6-month extension period, and some borrowers take that 6-month extension period. Now that increases the interest rate from 12% to closer to 15%. So it's good news. We want things to pay off sooner because we think it's less risky. But if it doesn't, we're getting paid for the additional risk. That's the idea behind it. And then,
hey, Sean.
Yep.
I've got a question because I know you said the average loan term is about 14 months. What's the standard type of deals you're doing? Because for like, a lot of debt funds I've looked at, they're fix and flips and they're a shorter term. So what type of deals are you mostly lending on?
So we'll get into that a little bit in there.
Okay.
But just to think about it, right? We're focused on the greater Boston area. If you were doing fix and flip loans in, let's say, Phoenix or, Texas, where you have a lot of like 1960s homes, you're doing a fluff and buff, you rip out the kitchens and you do some new electric. When you do a renovation on a home in Boston that was built in 1852, you're doing a full gut. You're essentially, and the values here are so high, right? So most of the home prices are selling for about $500 per square foot, right? So, and your rehab is about $200 per square foot, right? So the value's in the land. And so what a lot of developers are doing is, you're saying it's a fix and flip, it's a rehab, but generally these are full guts. And you're gutting it down to stud and you're leaving the walls up essentially because the new zoning wouldn't allow you to build something as large as you have there now, right? That's a tip. That's not for everyone, but that's a typical. That's why it's taking 14 months is because you're not painting here. You're ripping the walls out for almost every single.
That makes sense. Thank you.
But yeah, that's why you get to like 14 months. Some of it, we have had shorter term loans, but vast majority is, it takes a while to do a rehab and it's taking longer, right? So the process is getting more difficult for developers. And that's something that actually it makes it like when you have that house on the market, it's a brand new house. Well, it's harder and harder to get brand new house out there. There's more and more demand for it. And again, one of the things here is senior loans. It's about 100% with senior debt. One of the things we do is we cross collateralize loans. So occasionally we'll have a senior loan and then we'll have a bunch of other junior liens as additional liens securitize it, right? So there's not to secure our loan. We'll get into that more later. We have done 1 or 2 mezz loans in the past when we started the fund. And initially, one thing for the investors to understand, we started this fund. When we say we started it for ourselves, right now, my business partner, which is Dominion Capital, their family and, the kind of employees and partners in the fund are probably about over 50% of the fund's capital. We probably have, jointly about 35 million in the fund. So when we say we're invested alongside it, or you're investing alongside the partners, it's not like we're putting in 1% of the money. No, we've got, so across the investment committee, it's it's over half of the capital here. So we really set this up for ourselves, and we built this for ourselves, and we think about it. When we go to do a loan, we're not thinking about, well, hey, we just want to do this loan to get grow the fund. It's no, like, I need to do this. How is this protecting my own capital, and am I getting a good return on it? And so one of the things I've learned over years is, a senior loan is great. A senior loan plus a bunch junior loans over the rest of the portfolio makes you very, very secure, because somebody can't walk away from a project. But let's flip into the next slide. So where are we today? And so this is over time, just a quick snapshot. When we set this up in 2017, it was myself and the family office, and we started lending kind of all over the U.S. Right? We were in kind of half of it was in the kind of New England area, so Massachusetts, New England. But then a bunch of it was in New York. We have an office in New York. We did some stuff in the Midwest. We did some stuff in California. Loans would come in. And what we quickly learned was, and we quickly felt over time, and you'll see it here, is, we have an office in Boston. I develop in Boston. I know the market very well in Boston. We've done, 400 loans by now in, kind of in and around the greater Boston area, or close to it. Let's stick to what we know really, really well. And then when you want to go take over an asset, where are you better positioned to do it? Well, it's in your home market, right? You've got your own builders, your GCs, the local zoning attorneys, the inspectors. Stay close to home, right? Stay where you know what you're doing. And we kind of transitioned into being a local market sharpshooter. And that kind of really happened in 2021, 2022. You just see the increasing focus on Massachusetts and the New England area. And that's where we play today. I think we have a small bit in New York. We have an office in New York. Occasionally we'll do loans to borrowers that we know very well, and that are extremely well capitalized. But for the vast majority of it, we want to be in kind of the New England area, but primarily greater Boston, which is Massachusetts. And then loan sizes, we've grown over time, and there's two ways to grow. You do more loans or you do larger loans, and we've done a bit of each. What we found recently is the market that's doing very well today is the upper middle class single family housing market that is less reliant on mortgages, right? So somebody, you just think about the average home price in kind of the greater Boston area is probably over $1 million now. But if you want to get into your good school district, kind of just outside of Boston, so upper middle class suburbs, maybe you can get a home for $1 million, but that's probably a developer special that needs to be torn down. Your typical home that you're selling is anywhere from $2 to $3 million, and that's a starter home for your people that don't know the greater Boston area, right? So that's a good school district, and so what that means is our average loan balance is relatively high. And then so people will go, hey, well, is that a hard number to sell? And it's like, well, if you look at the regional economy and what salaries are, you'll go to some markets and you'll find the average home price there is probably, $2 million. Remember once there was one market and somebody says, hey, it's a $5 million home. How do you know it's going to sell? And it pulled up the last 6 months or 3 months of data, and there's 10 homes selling for $5 million plus in a very specific submarket. Probably somebody goes, okay, I get it, right? This is not, this is a different place than a lot of the rest of the U.S. as a housing market. But that's one of the things that makes New England really good, very good as a lending market, is you have a high average home value. And so when you're going to do all this work, you end up with $1 million loan and not a $100,000 loan. So it means you can spend a lot more time analyzing and investing time into the asset management of it. So let's flip to the next slide. When we talk about who's on our books and concentrations, so what we try to do is we don't want any one borrower or guarantor to be the majority of our concentration of our portfolio. And so what we did here is the 5 largest borrowers, and this isn't any individual loan, this is across all their loans. So they may have 10 loans with us, and that totals up to X number of dollars. But you can see the top five borrowers are probably slightly over 25%, maybe about 30% in total. But we've got 55 individual real estate developers, and that's currently on the book. As we go through, we've probably dealt with, over 100, well over 100, couple hundred real estate developers. And that's just kind of like the diversity of the book. And we want to keep that, right? So if any one developer declares bankruptcy or something happens, we've got another, large base to go from that we're still collecting interest from. And so that gives it, and that's what we're trying to keep, is that steady, right? We want to avoid too much concentration in one place, because we want to maintain those steady returns quarter over quarter with limited volatility. That's our real target. How do we do this? What's involved in our underwriting process? What are our targets? So this kind of, Chris, goes back to your question before, is there's two different types of loans. There's many different types of loans, but two different major buckets that we think of. There's the residential transitional loans, which are what you think of as your acquisition, renovation, your rehab, or a little bit of ground up, right? So it's your for sale product. So somebody's buying a piece of land, they're gutting it, or they're doing a slight fluff and buff, and they're putting it back on the market. Vast majority of what we're lending on are not just quick flips, but a little bit more construction involved than you typically see in the rest of the country, because they're older homes, right? But this creates more opportunity because, a lot of these, somebody can't just move into. And the other ones are commercial bridge loans. And commercial bridge loans could also be multifamily, so they're not necessarily just office buildings or industrial or retail. Throw multifamily in there. Somebody buys a multifamily portfolio off market, needs to close in 2 weeks, can't close with the bank, and then refinances those. So those can be actually faster churns because there's not really much work to do. So it's kind of like the thing where it's a true bridge loan. And so then where are we focused on our underwriting process, and what are our kind of targets, right, that we're underwriting to? So we want a max LTV of around 65%, maybe 70 some days. The rates we're targeting around today are around 11.95. That can fluctuate at any point in time. I think over, the lowest we've kind of gone in the past is a time was 8.95 when rates were zero. Doesn't go much higher. Sometimes we do a loan at 12.95. That's initial rate. It can always go higher when it's in default or in extension. About 80% of acquisition price and 100% of construction. We generally want to fund the construction because we want control over those construction dollars, and they aren't released till they do the work. So if somebody does the work and says, hey, I did $50,000 of work on this home, we have a budget for them, and it says, okay, framing was $50,000. We'll now release $50,000 to the account. But we have to see that an inspector has gone out there and say, hey, we've done it, and it's within budget and there. Recourse.
So you're a reimbursement distribution?
Yes.
Okay. Cool.
There are rare cases where somebody will say, hey, we're in a pinch. We've got 5 projects with you. I've got a lumber order coming. Do you mind funding, the lumber order on delivery? Because otherwise we wouldn't even fund a lumber order. They could have all the lumber there, but until it's installed, you don't do it, right? We will make exceptions upon occasions, but we try not to, right? You try to stick to your rules. And if your rules don't work, you need to change them. But this is typically it's a reimbursement, and that's incredibly important. I mean, Chris, I'm sure you could explain why that is true to a lot of the investors on, but that's something that we find, like, do the work, then send the money. Don't send the money, hope they do the work.
Yeah, this is something I like to look for when I think when you get the nuances of debt funds, like RD Advisors being one of them, is that's one of the ways helps mitigate risk and help just preserve capital, right? Because hey, the borrowers out there spending their $20,000, $40,000, $50,000 for that, phase one of the rehab, and helps protect fund capital where, hey, until that money is spent and verified by their inspector or whoever, verifies it, then the distribution is dispersed, rather than saying, hey, give me the money. And they may take off and not spend it on that project, but they may go to Vegas. Yeah. They may try to, use the money to go save another deal over here. And, that can happen in real estate. So in general, I think reimbursement lenders, and this is just my personal philosophy, just help mitigate risk and preserve LP capital.
Yeah. And one of the things there is we like to budget for 100% of construction. And our view is, because if the borrower doesn't finish the project, then we need to step in and we need to have budgeted that we're going to do it ourselves. And so, for example, if a borrower says, I can do the project for $100,000, but we look at the project and we send an inspector out there and they said, I don't know, this is really, it's really cost $120,000 because if you're going to hire a GC, they're going to earn $20,000. Our budget isn't the $100,000 that the borrower says they can get it done for. It's $120,000 because if we take over the project, that's what we can get it done for. So that's a big distinction. So you really just don't want to under budget because you don't want to find out that you're thinking a project is a great project, but then it's, and we generally don't deal with novices. Somebody says, hey, this is my first project and I'm going to get it done for 20 grand. You're like, yeah, like this is not happening. Most of our borrowers are general contractors directly themselves. Generally, so again, we want people completed projects. Our target FICO, is 680. If it's not a 680 FICO, we're really going to want to see some compensating factors, i.e. we're going to see additional collateral, a really strong reason, not to fund a borrower when the FICO is below 680. Bank statements, we want to show liquidity. One of the things that's important that we do is a lot of lenders fund an interest reserve for the full length of the project. And we hate doing that. And the reason I hate funding an interest reserve is, let's say your project stops halfway through construction and you funded an interest reserve. So they haven't touched the project in 6 months, but they've got an interest reserve on it. They haven't defaulted. So you've got no default, you can't take over, but they aren't moving the project. So eventually it's going to go into default because it's not getting complete, but because the loan is being paid, you can't do it. You also realize problems happen so much later. We're a cash pay. I want to know that my borrowers can make a cash payment every single month. And if not, I want to step in. I want them to default as soon as possible. I don't want to hide defaults. I want to confront defaults. And so I think interest reserves mass defaults, right? Mass problems. I want to quickly address problems, step in, take over the project if I have to, complete it myself, and keep it moving. We don't want things going stale. And I think that's a critical differentiator for a lot of loans. I think a lot of these mass securitized loans that are out there, they have very low defaults if you look at them on the surface. But what happens is if they do go into default, they've got a larger loss factor. That's my gut sense. I don't have the empirical data for that, but I think that's what's happening on some of these. That's just kind of what I've seen on the ground here, where it's like if you got an interest reserve, you let that thing run, and by the time you get to it, it's a disaster. We like to avoid that. So how do we originate these loans? And Michael's like moving me along. He's watching at the clock and he's like, Sean, you can talk for an hour on that slide. Let's go. So how do we originate loans? So I actually don't have any originators on my team. Very unusual for a lender. And you go, how the heck do you not have originators on your team? How do you get any loans in? Well, we've been around for 8 years. People know who I am. I own properties in Boston. Brokers know me. We have funded over 400 projects. People tend to look for capital. I'm on stage quite a bit. I'm on Zooms, webinars. We do a lot of, you can see my office behind. I'll just kind of lift this up. You can see our office behind here. It's a large kind of loft space. We do a lot of events here for builders. And this is our kind of conference room here. I'll just kind of zoom you over. We'll throw up, construction budget here. Is, Michael sitting next to me. We'll bring a bunch of developers into the office to chat about accounting for construction projects. And then we'll go into, so anyways, we do, a lot of it comes in through referrals and thought leadership. And that's how we want to bring in business. And then we're on, you can find me on LinkedIn. I think I've got close to 15,000 followers now. Probably, good, very large portion of that, percentage of that is in the greater Boston area. So, we're a known quantity. And we don't want salespeople on our team because I don't want somebody overly eager to do a loan, right? I want somebody overly eager to underwrite a loan and make sure we're not doing bad loans, but I don't want somebody to push a loan down my throat as a salesperson. So let's go to the next one. So once that loan comes in, what do? That's what our team is set up to do, starting on the initial review. So we're looking at it, and my background is real estate private equity. I'm looking at it from a pro forma standpoint. So a loan comes in, the first thing I'm doing is the sponsor going to make money in this project? Are we going to lose money, but is the sponsor going to make money? And so maybe we look at it and we say it's a low LTV, but they're not making any money on it. Why would they do this, right? Maybe they have a different view on sales prices than we do. And we probably, because we lend on so many projects, have seen so many markets and done so many. We might have better insights into a market than the borrower does. We share those, and that's why we get a lot of leads. People call me up and say, "Hey, what do you see single family, 5,000 square foot single families in Newton going for now in this, in the Woburn submarket? Can you give me a quick read on it?" I go, "Oh, we've just done 2 projects there. Here's how they've done. Go chat with, Joe, give his contact and he'll tell you how it went." Right. And by the way, the inspector is tough on these things, so you're not going to get through historical committee, right? So, just knowing those type of things, an initial review from a developer's standpoint and also from a lender. And that's why it's great being local, right? You see so many deals in the same market, you really know a local market. I don't know, market out in the Midwest, and I don't know a market out on the West Coast. I'm not going to be a great evaluator of, the values or the process of constructing there. I am going to be an expert in Boston. So what do? Initial review. We like it. We send out a term sheet. That generally happens in, somewhere within 48 hours. We try to do it the same day, but, we go back and forth internally on it. Investment committee generally means myself and a credit officer approve it. So the team will present it. The credit officer, this is almost immediately. We use Slack. And so these things are going on in a Slack channel specifically to approve these. We'll go through the project. We have a system. We're underwriting it. We'll ask questions back and forth. We'll then discuss the terms, and then they'll send it out. And the person who's kind of underwriting the deal can't be the one to approve and send it off. So everyone pretty much has to have 2 sets of eyes on it. And if somebody else works on it, it'll come to me if there's exceptions and say, "Hey, Sean, do you approve this?" Full due diligence. So we'll send out immediately. They sign the term sheet. As part of that, we'll send out a due diligence package, and we'll collect information on credit score. So we'll run a credit report, and we'll run a background report. So we're looking to see, what are we looking for in the background on the sponsor? One, we want to see what the credit report is. We also want to see what payments they've missed. So have they missed a payment? Was it a mortgage payment, or was it a credit card payment that they weren't aware of because they had no idea, right? So there's different, weight on it. Are there lawsuits? Were there somebody that was involved in 5 or 6 lawsuits? Do they have a criminal record? Was it criminal record? Was it something that, was it murder, or was it, was there mortgage fraud? What's going on there? Was it just hey, you didn't show up for a hearing for your parking ticket, right? All that stuff we're finding, we're valuing. And if anything shows up on, the background check, due diligence, we have to go to our compliance team and say, "Hey, here's presented. We found this stuff. What do we do with it?" So we have an in-house legal counsel do these. Most of the time it's clear and we're going through it. And the vast majority of our clients are repeat clients. So kind of almost, 65%, 2/3 of our clients are repeat clients. We already have all this stuff. So we refresh it once in a while, but we already have the information on them. So that part could be very quick. Closing. So we have about 3 closing. Yeah.
Can I ask a question on the DD? How do you do your appraisals? You obviously have incredible market knowledge. Do you guys just kind of do your own internal appraisal? Do you do desktop? How do you do the 8 LTARV?
So we first do our own internal appraisal. So we have access to MLS. People here in the office have their licenses. We have several software systems internally that we can use that do auto appraisals, like desktop appraisals internally. And then we'll hire a third-party appraiser to go out there, visit the property, and do their own report. So the internal valuation is what we kind of rely on internally. And I tend to think that we probably know the market better than the appraisers do. And we evaluate it differently. So internally, we're not looking and saying, "Hey, what were the 12 months of what did Sing sell for 6 to 12 months ago that indicates what the value is today?" We're kind of doing it differently. And we're going and saying, "Okay, what's sold in the past kind of 3 months, right? What's happening today? So you're valuing, because 12 months ago could be a different market. Interest rates could be different, right? So are you looking at a lower interest rate market? Are you looking at a different market? And then going to look at and saying, "Okay, well, you want to sell this house for $2 million. I understand the identical home sold for $2 million 3 months ago. But we also are looking at listings on the market today, and we know inventory is rising. And I see a home that's even better than it on the market for 1.9. And so if that one that's better than the one, bigger than the one that you're selling for $2 million is at 1.9, even if the appraiser can get the numbers at $2 million, I know that you're not going to sell it for more than 1.9 because there's a current listing that you're going to compete against that's at 1.9. Now maybe there's an exception, right? Maybe there's something we don't know, but we dig into that level of detail of what's happening currently in the market to figure out what our internal renovate ARV is, because it's my money. I don't want to lose money. I don't really care what the appraiser says. I care about what the appraiser says as a double check, right? So we don't want to be more than the appraisal, but we certainly don't want to rely on that without doing our own homework as well, which goes beyond that because we're checking on the current market. We're calling brokers, right? If we don't know the market intimately because we're not in that specific submarket or we have some doubts, we'll call local realtors and say, hey, wait a second, why isn't this house moving? What do you think about a house at this price? And kind of take that in there.
Great, thank you.
Get an idea. So closing, we have closing attorneys. Our docs are standard. They're non-negotiable for the most part. And we'll kind of go into what's in those docs, but those the loan docs can happen. Once we have all the information from the term sheet and the due diligence in the system, that then generates the loan docs that go straight to the loan officers, to the closing attorneys. And so the closing attorneys don't have to write up a new set of loan docs. No, we have our own proprietary loan docs with our terms that are kind of battle tested, that we've used hundreds of times. And we continue improving. They're almost like proprietary technology as our loan docs. And people don't really think about it until you go and we had to go over an intercreditor recently. And there's one clause in there that's super important that we have to have in our intercreditor. Well, that's why we have, such a good in-house legal attorney. Is typically a firm that's doing loans our size wouldn't have such a strong intercreditor agreement, but it puts us in a very powerful position if there's any second liens. So, just the little things like that where you're continuing improving your docs, they become part of your proprietary technology versus somebody who's just started and doesn't really have, a super robust in-house legal team. Very, very different. Post-closing review, everything closes. If there's anything missing, collecting those last minute documents, and then, leverage or syndication. We don't really syndicate our loans too much, but, we do have warehouse lines of credit. Juan Carlos runs the process of onboarding those loans to making sure that everything is in compliance so we could borrow against an individual loan. Asset management, if everybody pays on time through an ACH payment, it's pretty easy. And every single kind of like around today, we probably just ACH'd, 60 or 70 borrowers and just pulled the money straight out of our account for this month's interest payment into our bank accounts. And that's how we get it. So that's really easy if that's all it was. But then of course it's developers and, things happen, right? So they need distributions. They need, draws. So if you're doing 60 loans, how many loans have a draw every single month? So that's real asset management. So you need to review those draws. You need to make sure that the reports are good. You need to make sure they're still in good standing. You need to check on things to make sure there's no other liens. And that's just if a loan is doing well. And then you go into the place where people miss a payment, and then all of a sudden you're chasing after somebody's payment. And it could be because, oh man, I forgot to tell you, I switched bank accounts and I didn't send new ACH, information. And so that's the accounting department that handles that. Or it's hey man, sorry, I'm having a rough month. We had to go buy lumber and I don't really have any cash to pay interest, in which case we need to decide, do we start foreclosing on them? Or is this something that they can cure and we leave for a month or two, right? And so then we start working with the borrower to figure out exactly what is the remedy, right? And that's the real asset management. And that's kind of the boots on the ground stuff that, I would say that's like, the small bit of the loans, but all the time. And then documents, pre-closing. Juan Carlos, do you want to walk us through this? I mean, I think we've gone through a bunch of these, but
Yeah. I think you've covered most of the process in the most comprehensive way, but I can kind of walk through the pre-closing package, what we obtain before we close the loan. And keep in mind, we're working with very short timelines most of the time. So we've closed loans in as fast as, I would say, 3 days, Sean, if you agree, depending on the type of transaction. Yeah. But a lot of the times we have to jump in where there's not a lot of time to close, especially with bridge loans. You're dealing with a very short timeline. So you have very limited time to obtain all these documents. Most of the times we obtain most, if not all, these documents before closings. In the rare event that there is something pending before closing and we're We have a pretty confident opinion of the value of the property, that the full commercial appraisal or the full, residential appraisal is not complete by the time of closing. We'll make it a post-closing condition so that if it's not completed and delivered within a certain point in time, it is considered an event of default. But typically, this is everything that we are getting for our transactions, either residential or commercial. So as Sean said, we're starting with a pro forma, and we're looking at the project from the perspective of the sponsor. So the first question is, are they making any money? Before we're looking at our position, we're looking at, as the sponsor set out to make any money, is it worthwhile for them? And we're looking, how much is it going to cost to carry the project? How much is it going to cost to finance the project with our own, terms, with the terms that we would typically offer for this sort of project? Is their opinion of value what we think the opinion of value is without even looking at the appraisal? Do we agree on the after repaired value or the initial value of the property? Are they getting in at a good price? If that makes sense, we'll put together a term sheet that kind of outlines the terms of the loan. Credit memo. So we put together a full credit memo for all commercial transactions. We don't typically do it for a residential transaction. However, as Sean mentioned, in our own proprietary system, we do have a full write-up of why we're doing every loan. And that kind of gets, forwarded to Sean and Mikhail, who are both principals, and the rest of the firm as well, so that they can understand the story behind each loan. But we'll typically put a full commercial credit memo only for the commercial transactions. The appraisals and BPO, just to go back to what you said before, Chris, we're not getting just desktop appraisals for these. We're getting a full residential appraisal according to Fannie Mae guidelines with a full interior inspection of the property as well. We're reviewing these documents. I think our most important point for the valuation is our own internal valuation, because in a lot of cases, we do think that we know these submarkets very well. However, we're typically getting a full interior appraisal for the residential loans and a full commercial appraisal for the commercial loans. Entity documents. So, all of our loans are made out to single asset LLCs, basically SPVs. We're not lending out to individuals. And that just ensures that you have a stronger collateral package, and it makes it easier to take over an asset or the sponsor entity in the event of a default. We're getting bank statements for most of the transactions to make sure that the borrowers have the liquidity to carry the project and to service the loan. We're typically reviewing a track record. At this point, as Sean said, 2/3 of the borrowers are repeat borrowers, so we have a pretty good idea of what they have in their books and what they've done so far. An operating agreement, which is part of the entity documents, a purchase and sale agreement. So if they're purchasing the property, we just want to confirm that what the purchase price is. Sources and uses and insurance. We do have our own insurance requirements. And, if someone doesn't have proper insurance coverage at any point during the life of the loan, that is an event of default. So that gives us the option to take over. So we want to make sure that people are insured. So this is kind of a snapshot of what we get. We may get more for an individual project, depending on what the project is, if we need to get an environmental report or anything else. But this, I think, should give you a pretty good idea of what we're looking at before the loan is closed or by the time the loan is about to close.
And there's a lot of conversations with the borrowers back and forth and the team. And there's like individually in our team, there's it's like we've got a Slack channel, and it's like each thread is like a discussion, almost like you'd have here on like a chat of, yeah, but I don't, and like we'll argue back and forth. It's kind of fun. Like we've got everybody in the team has been working so long together. It sounds like, sometimes like, some old grumpy couples, arguing back and forth about some sort of transaction or market. And we all really need to be in agreement to do a transaction. And anybody can speak up and say, hey, like, Sean, I know you like this deal, but like, I've only been here like a year or two, but like, I don't, like, here's what I just doesn't make me feel comfortable. And everybody takes those views on board. And I think it's important that it's not just one person looking at all this stuff. It's kind of like much more of a team effort. So we'll kind of get into it, what we have. Let's go into the closing documents. So what's in the closing package, Juan? What do we have here?
So the closing package, our main security package is basically 3 layers. So at the very top is we're getting a security interest on the property. So all of our loans today include at least one senior mortgage. It's a mortgage on the property that goes in the public records. As Sean mentioned, in some cases, we might get junior liens on other projects that the sponsor may have just to enhance the collateral package. But typically every loan that we close includes at least one senior mortgage. On the level below that, we do have a pledge of the shares of the borrowing entity. So as I mentioned, all these borrowers are borrowing money through single asset entities. We're getting a pledge of the shares of this LLC. so that if you can't, you could foreclose on the property by going through the mortgage, and you can also take over the borrowing entity through the pledge of shares and the UCC filing that you get. And at the very bottom, you're getting a personal guarantee for most, if not, I think all of our loans, Sean, is we'll get an unlimited personal
Everything
guarantee.
has a personal guarantee. I don't know anyone that doesn't. I mean, again, all
Yeah.
these are pretty like standard document packages. It's not like we pull it together for each individual loan. Like this is what you get sent out, and if there's anything there that you need to, is there. And so other things like, then there's a whole bunch of documents. I mean, this is over, and we were talking about like, hey, let's go through it, and we were talking about like, hey, maybe we should take them through our documents, and it's like, yeah, guys, this is over like 200, 300 pages of like, Juan Carlos, can you go down to page 197 of the, of the loan agreement? And, we want to flip to the clause we're talking about. And it's just like, well, we talk about proprietary technology. Like really there's a lot of tight stuff in there that we use to secure that each individual loan is fairly secure. So we want to set it up so that we can collect money at 3 different levels on every single loan across 100 different loans in the portfolio, right? So, there's a lot of security there. There's a lot of diversity there. This is really how, this is how we're keeping this all secure on our side. And it even gets more complex, right? Like add a couple more loan, make it a portfolio loan with 4 properties and some additional collateral, and it gets all, and then add an intercreditor on this because somebody else is bringing in a junior lien or existing lien holder. So, but there's a lot there. So, and then kind of talk about the team that gets this done. It's myself, my partner, Mikhail. We're fairly active on it in terms of, approving all the loans. We have a credit officer. It's actually my brother who's worked in real estate and actually runs, we talk about kind of like the Bigger Pocket connection. We own our own multifamily portfolio in Boston. We started I bought my first property, triple decker, so 3-unit property in 2001. That was about 6 months out of university and kept buying. And so we've built up a portfolio in the Boston area of kind of, I would say 3-unit to, 12-unit buildings. And that's outside of the portfolio. That's just my own personal experience on it. My brother was involved in that, and then he did underwriting. And so now he does all of our he took his underwriting skills from underwriting Fannie Mae and Freddie Mac loans and commercial properties to now doing it for us. So he serves as a credit officer. And then Alex has been with us, I think 7 years now. Daniel and Jorge have been for us about 2 years. Juan Carlos here has been 6 years now. Juan Carlos,
6 beautiful years. Yeah.
Holy, Joe runs our, is our effectively director of accounting, really our CFO. Kind of when you run to it, we have another junior accountant. You just think about the amount of accounting that goes into this. So you have 100 loans at any one time, but 400 loans across several years, each of which needs a loan statement every single month, needs to have, you're changing the loan balance every day. There's a huge accounting lift here of keeping track of all this stuff and keep track of the payments. And you need to have a robust system to do this. And then we have advisor and legal. Thierry is a Harvard Law, graduate. He's been the in-house legal counsel. He's been a chief compliance officer or a compliance officer for NatAccess for a bank. So we really try to bring in institutional level expertise. Michael Peterson is working on the investor relations side as well. Here with us. He worked for a number of other private credit funds in the accounting side and then in the investor relations side. So, he's kind of got deep expertise on the kind of within private credit, but within investor relations within that. And we're continuing to grow our team. I think we have quite a few people here that aren't shown. We use a lot of outsource. So when we go to do inspections, we use an outsourced provider because they will do the inspections. It's a third party. It puts some distance between us and the borrower as an individual so that, hey, this is the report. This is what was filed. If something's not correct, we need to take it up on what's wrong here, but it's not an individual thing with our team. And that allows our team to really spend their time underwriting and analyzing investments and dealing with the asset management side of it. But,
hey,
and then, yeah.
Hey, Sean, I know we got about 10 minutes left. There's a couple questions. I want to make sure we get time to just keep an eye on the clock here.
Yep.
Can I rapid fire these to you guys? There's two in here.
Go. Go.
Milton says, do borrowers make loan payments during the construction phase or pay in full when the property sell?
We make it monthly. Yet we don't, we don't report. If a borrower hasn't paid in cash, we don't report it typically as in our monthly report. So we are cash accounting. And so, somebody's in the construction phase, unless there's some additional collateral that gives us or a super low LTV, we typically don't do an interest reserve. So we need to check for liquidity before they borrow from us. Liquidity or income, right? So somebody could have a construction business and they're earning money as a general contractor and doing a project on the side, and that's how they're funding the project. But it's got to come in cash.
Great. Next question. Rick says, what percent of non-performing loans are current in the portfolio, and what's your historical average, and how many deals do you have to take over?
Yeah, so great question. I mean, everybody wants to know about defaults, right? It's like, and I'll tell you, I'm the first one where I don't know if a loan is performing and you just ACH it every month. It never rises up. I don't hear about it, and I don't know
Yep.
the exact details because we've done over 400 of them. But I can tell you the name of the borrower, the address, almost everything about all the loans that are in default, because those are the only reviewed ones that I have to spend tons of time on every single month. And so historically, and Juan Carlos, correct me if I'm wrong on this, kind of less than 5% and maybe less than 4% of our loans have gone through auction and repaid through auction. So defaults are higher, but a lot of people will default as he imparted, like you can default because you didn't have, your insurance doc expired, right? And so then you can reinstate that. Non-payment defaults, so then these are non-performing loans. We typically measure that, banks measure it as 90 days past due. We kind of use that as our benchmark to match the banking market. Because if something's like within the month, yes, it's past due. We record it internally as past due and we chase after it to make sure it doesn't get worse. But that's not the money's still coming. It's not affecting returns because it's still coming in within that same month. But it's a leading indicator that, hey, something's up with the developer, right? We really want to, if it's not due paid by the 5th, we consider it late and we collect late fees. It's not due if it's not paid by the 10th or not paid by the 11th, typically it's an event of default. And default interest starts kicking in. And so then we can collect 24% interest. We don't always do that, right? Somebody pays on the 11th and they say, hey, listen, sorry, just wires crossed or mixed up and bank accounts changed or whatever. Like if it's a one-time thing, we'll ignore it. But so the vast majority of our projects pay off without foreclosure. Defaults typically run anywhere from 6% to 12% of the book. I think now it's probably trending towards a little bit the higher end. But that's pretty normal for the industry for a lot of these as they're construction loans. And I think one of the things I mentioned is we probably run a higher default because it's current pay and people need cash pay. There's not an interest reserve. And we do that intentionally, right? I'd rather have a higher percentage of defaults and a higher recovery percentage than a low default ratio. But then when something goes into default, you're in deep shit, right? And so what we found is on our defaults historically is we've done almost as well on our defaults as or better than we have if we paid regular interest, right? Because our default rate of interest is 24%. Our LTV is about 65%. We take over a project, we try to capture some of that back through default interest, or we try to capture the project and sell it for a gain and complete it ourselves. So it's kind of giving a little bit more color on it, but I think that's one important thing that I think a lot of other people will probably have a similar question around it.
Cool. No, that was great. I've got one more question here that I missed from earlier. I'm gonna paraphrase it. Tommy was asking about the differences on the Class A and Class B shares. One was a lot of friends and family with a 7-year lockup period. Does one or the other take priority, or could the question is, does one or the other take priority, or could one impact the returns of the other?
No, not necessarily. So A and B, like just different, like points of time, right? And effectively all the because we've been around for 7 years, all those, B class shares essentially now in a redemption period anyways, right? They're staying on. But friends and family, when we first invested, we started with 15 million, right? We're now up to 35 million. And it's not friends and family. That's direct. That's not friends and family. No, friends and family, that is 35 million plus is people that are directly employed for the firm or their family or their direct family, i.e. like, husband and wife, right? So, or, parents investing on behalf, right, of, out of their own trust. But that 35 million is pretty much people that you see on pictures on the screen today. That's that 35 million, or probably 38 million today. Is that, Juan Carlos, is that fair?
Around
pretty
that,
much
yeah,
on the
around that
screen,
amount.
right? So like that's who is there.
Give or take
right?
a million. Yeah. Awesome. Cool.
So
no,
yeah,
you
you're
answered the
looking at
question.
You're looking
and I
at
know
it.
Cool. Yeah, that I love it that you guys have a huge co-invest with it. So I know we have 5 minutes left, and we do have to end the top of the hour. So thanks for answering the questions, and yeah, go through because we could talk 5 hours on this.
I mean, like typical project here. Look, I mean, we have these things. Yeah, I could talk literally. I could talk for 5 hours, but I'm going to get thrown out here. All right, this is what it looked like before. Quick. This is what it looks like now. It's two separate. It was one family. Now it's two family.
That's a $2 million home.
What?
That's a $2 million home.
It's actually two homes. If you look at it from the side, it's two side-by-side houses. It's townhouse style. But yeah, that's a $2 million home. That's not even an expensive neighborhood, by the way.
It's all relative.
Yeah. But it's pretty.
It's gorgeous.
Chris, where are you based?
I'm in Denver, so we still have some high prices, but not quite as high.
No, I mean, I don't know what you can get for under $1 million here. I mean, it's good luck. All right, there's a commercial property that we've done recently, and we can just flip. I don't remember what other slides we had here just to go through. That's actually an office to resi conversion that we've done.
Oh, cool.
So I think it's probably doubled in value because they've gotten their permits now to convert it to residential. Flip through. Let's go. What else do we have? We pulled together this commercial memo. We pulled together. That's actually automatically generated. And then here's our questions slide. And then one more thing to flip through. Do we have our documents just so people can see it on for how they can invest? Because I think that's always an important thing is how do you invest? What is a min investment? So minimum investment is $50,000. You can top up $5,000. People normally top up more, but closings are monthly. So that's important. It's like, the next available window to invest is, November 1st, because today's October 1st. So you would typically invest or kind of contact us by the kind of the end of close to the end of the month. I mean, you can do it anytime during the month, but really you need to get the process started probably about a week or two before the end of the month. Juan Carlos, is that fair?
Yep. Sooner the better.
We're accepted for custody at Fidelity and Charles Schwab and a bunch of IRA providers as well. So that means you can go through effectively your pension fund and invest kind of similar to how you would with a mutual fund directly out of your pension. And so, personally, a lot of my investment is through my Fidelity account with a wealth manager. You go and say, hey, I'd like to get it. You don't Google, you don't go into Fidelity and ask them because they have no idea. They don't know how to do alternatives. You go to your wealth manager or you ask us and we onboard it with Fidelity.
So one thing I'll note here, because a lot of debt funds, they have the end of the month closing. Right? Hey, DocSign, wires in, accredited verification by end of the month. I've run into this and saying that people, like if you are investing through a self-directed retirement account, start that process sooner rather than later. Because nothing in the self-directed world moves fast, and I have missed deadlines because it'll take 3 days. 2 weeks later, the paperwork and the wire gets through. So just as a little tip for everyone out there.
100%. Yes, agreed.
No, we've had I've had, and we were pretty strict on it. Even with my own investments, I've tried to do it. Gone to my wealth manager. Somebody's been out of the office. I've had a wire for $100,000 or $50,000 going in and said, hey, I want to catch it because I don't want my cash sitting there earning zero for 1 month. And then I miss a 1 month return.
Yep.
And it's like, oh man, this sucks. And now you got to wait till the next month. It's just a pain in the ass. And I've missed it. I've had to go back. And Juan Carlos has been like, look, like rules are rules. It's like, we're on the pun. They're like, yeah, well, you also made the rules. So,
Donna, before I know we're running out of time here, but just to stress this, so if anyone wants to reach out and get access to the data room, see more information, schedule a meeting with us. The email is right here on the screen. It's the IR email at rdadvisorsre.com. You can also just go to rdadvisorsre.com and request access to the data room. That's the main point of contact. Who you'll be speaking with, you're seeing on screen. So it's Michael, Sean, and myself. So I just wanted to put that out there before we run out of time, Chris.
Yeah.
No, this is perfect. Oh, go ahead.
And I saw a couple more questions there that I can try to answer. So why do we have an office in Lima, Peru? Juan Carlos, do you want to answer that or should I?
Because it's a fantastic and beautiful city full of smart people like myself. But I don't know if you have a different take on it, Sean, but
yeah, amazing food. And it's great for the team to go down and visit. So we hired Juan Carlos years ago. He's been an amazing hire. We hired him out of NYU. And, when we needed some additional help early on, we hired, one person out of kind of like outsourced out of Peru that was, he knew very well and was in the same, I would say, English speaking school. And then we found that they were amazing and pretty much as good as the talent we could get in New York or Boston. And we said, hey, we're going to build out a team and we can get talent that's as good as we're getting in Boston or New York. Let's build out a single office for, kind of our support for servicing, analysis. So we have a team in Boston that'll really be focused on the value and the underwriting, but a lot of the Excel work, a lot of the servicing, a lot of the asset management, that can be done from anywhere. And also a lot of our borrowers, Boston is a pretty diverse space. A lot of our borrowers are, Hispanic or, Brazilian. And so it's great to have people that speak a second language, and it's easier to hire people that speak a multitude of languages in Latin America than it is. But these people are, university educated, top universities in Peru. They are English speaking. So they've gone to English speaking high schools and English speaking, effectively their entire education has been in English. So very few people notice that they're in Lima, Peru. But that's why I've hired them there. They've been absolutely phenomenal. And plus it's a great place to go down and visit. And they come back and forth, once in a while, and we go down there somebody's always down there once in a while, just once a quarter. And then good question on how interest rates affect future returns. I think we went through it like historically. Our returns have been pretty stable. I haven't seen, with like these massive run up in interest rates, like drop in interest rates and then run up in interest rates, the returns remain fairly steady. There's a little bit, I think our rates may come down if interest rates go super low. But part of it is people, we're charging what we charge for interest rate because nobody asks what a life rate cost in a storm. And we're a high performance product, right? So, we're closing in 2 weeks in as little as 2 days. We're not fighting for
Banks don't do that.
Transactions. We're fighting for individual borrowers, and they're coming to us because of our flexibility. If they want cheap rates, they go to a bank, right? And I tell my borrowers, like, hey, I think you have enough time to go to a bank. Go to a bank on this one. Call me when you need me. Don't call me when you don't need me. This one you don't need me for it. There's plenty to go around. And so we really focus on that high performance one. So we're able to charge a higher interest rate to that, which is different than where the rates are, right? It's not about liquidity on it. I do think if interest rates fall, then it'll be easier for developers to sell their houses on. So anyways, that was, I think, and also our own cost of borrowing falls when interest rates fall. So the delta, it's actually probably better for us if interest rates fall because our rates are less sensitive than the Fed fund rates.
Yeah. Awesome. Well, I know we're a few minutes over, and I see a lot of comments in the Zoom window saying, hey, thank you, Sean and team. Great deep dive. Reminder, if you guys want more details, you can check out the deal room in Passive Pockets, or reach out to Juan and Michael on the IR team for more details out there. I definitely let them know that you're with the Passive Pockets community. Helps us to kind of track to know where people are investing. But big thank you, Sean, Juan, Michael. This was fantastic. I always love doing deep dives like this, so thank you so much.
Thank you very much.
Thank you for
I'm
having
going to
us.
leave. Or should I stay on or should I flip off?
I think we are good, but we'll let Alexis come back. I think Alexis, we can sign off now, right?
Yep.
We are
Yep.
still alive, just as a reminder.
Yep. You all can sign off. Thank you all.
Perfect. Thank you, Alexis.
Hey,
Thank you very
Chris.
much.
RD
Thank
team,
you, everyone,
guys
for
are
joining.
fantastic. Thank you.
Thank you.
Thank you. Bye.
Bye.